Bell rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno-monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager.
I'm the senior trader for the Forex Super Model, and this is the technical issues part 3, which is assessing volatility. So this is a series about technical issues, and we're going to look at the idea of volatility. Now in part 1 we looked at how volatile is my FX pair, which was looking at the sort of source volatility of individual pairs. And we're now going to look at volatility in general in the markets. So let's have a look then. So when you're talking about volatility, most people understand it as to be how erratic or how much movement or how much it's jumping up and down, how much the market or an individual pair or whatever is. So how is it moving? Is it sort of moving steadily, or is it moving in a volatile manner? So is it sort of just jumping around? So that's the first thing. Now how are most traders taught to assess volatility? The default trader generally assesses volatility in 3 ways, and the first way is moving averages. So moving averages. Now, as we said, you've got EMAs, TMAs, and SMAs are the main ones. So exponential moving averages tend to be the fastest, TMAs mid-range, and SMAs, simple moving averages, are generally viewed as the slowest reacting to change. So these are, if you like, default measures of volatility. So and what most traders are looking at is 20, 50, 100 and 200 moving averages. So clearly the shorter the moving average, the quicker it moves and the quicker it's affected by any change, and the longer, the less it's affected. And so volatility excuse me, in this sense is viewed as how moving averages sort of move in terms of, so if that was the 200, 100, 50 and 20. So one measure of volatility which people are normally familiar with is how the moving averages are moving, and when they spread, so you get this sort of like spread, they're tighter here. Excuse me again. They basically are an indication of increasing volatility. Also, if you get like a 100-day, say, moving average, and the 20 starts shooting through, then that's a measure of volatility as well. So that's one thing that traders are taught to look at. And we're going to talk generally about some alternative measures of volatility which maybe you haven't thought about and will be useful to you in your trading. So Bollinger Bands is the other one. So Bollinger Bands viewed as a measure of volatility. So when they're tight, volatility is viewed as being relatively low, and when they start to expand out, volatility is viewed to be increasing. So that's Bollinger Bands. They're sort of dynamic support and resistance type indicator. It's a variation on the theme of moving averages. Right, so that's moving averages, Bollinger Bands, and then the third one is the good old ATR, average true range. Now, ATR, average true range. So let's say we're looking at the daily. So the average true range on the daily, for example, and then so if the average true range is increasing, it's viewed as the volatility is increasing, and this is actually quite misleading in most cases. But we'll go on to that. And if it's so, that will be rising volatility in the default sense, and falling volatility now. So there are your three sort of default rank and file methods of viewing volatility, and there are others, but they're the main ones. And I want to share with you some alternatives that you can look at, which you may not have thought of, or you may not have used in a certain way. So one of the things to look at is movement versus swing. So what do we mean by that? So let's suppose on your normal candle you've got a high and a low and an open and a close. So in this case it would be a red candle, because the close is below the open. So now the swing that we call it, the swing is between the high and the low. That's how much the market. So that's the swing, and then the movement here between the open and the close is another indicator. So if you look at, for example, if you look at hourly or daily or charts, I mean, you can look at any chart in this basis, but if you look at, say, an hourly chart, and you can see that the candles have got very large wicks, or they're looking like that, you know that there's been relatively a large degree of swing relative to movement, and that suggests volatility. So if you're looking at a market and the last 3 or 4 hours has been doing this, and it's got significant tails with big movement and big swing and little movement, then that's an indication of volatility. Now that's quite a good indicator as well. So that's one thing you can look at. Now, moving on to the next thing, and they start to get a bit more unusual as we go down. So the spread. So look at spreads. Now, volatility, in terms of volatility, your financial instrument spread will widen normally. So when spreads are going up, volatility, and there's good reasons for this, which we don't need to go into detail, but suffice it to say that when you're getting significant changes in underlying volatility, then to compensate, the market makers will open the spreads, widen the spreads. Likewise, falling spreads or tighter spreads will be a fall. Normally, is a fall in volatility, and sometimes your broker will even put up little flashing signs for you to say, you know, greater volatility is expected in the next few days because of X, Y, and Z. Say, I don't know, a Brexit trade deal or whatever. So they can actually give you a heads up to increasing or decreasing volatility. But you can look at, if you get your watch list on the go and you've got your currency pairs or whatever, you'll see one of the columns is the spread, and these are changing fairly slowly. But if you just make a note of the spreads at the start of your trading day, and then you can, you know, it's very difficult to just keep all these figures in your head, and then you can just get a rough gauge of are they staying static, are they increasing, or are they decreasing, and so looking at the spreads is an easy way to get a bit of a fix on volatility. Right, so that's that one. Now we're starting to get a little bit more bizarre now, but now let's look at so what's the next one is now screen flash frequency. Now you probably just naturally look at this, but if you actually in our organisation we actually can monitor screen flash frequency, and what it does is, obviously if the market is quiet, the changes in the underlying instruments, say euro dollar, euro yen, euro pound, all the currency pairs for example, they're sort of pulsing away, and the screens are flashing at a pulse. Now you can measure this pulse in hertz. Now hertz is the scientific measure or metric of sort of frequency, not frequency, yes, the frequency of an event. So 1 hertz is 1 event per second. So the second hand on your watch, by definition, moves at 1 hertz. That's how it is deemed to be measured. So if the market is pulsing at 1 pulse per second, you've got a 1 hertz volatility pulse. Now if the market starts boom, 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 the hertz rate goes up, and you can actually measure this it's difficult to measure, but you can measure it if you enclose a screen and use a light meter and a pulse meter. But nevertheless, I don't suggest that you go down that route. All you need to do is to just view it in a more generic overview type thing. So you need to say, how is the market? Is the market screen flashing? Is it aggressively flashing at you? Is it going boom, boom? And is it getting faster? And if it's getting faster and the pulses and your hertz rate is increasing, then volatility is increasing. And you'll find that at major changing points that you get this like frenzied pulse rate where the screen is pulsing like a mad thing. And then all of a sudden it just drops off, this pulse rate drops off, and the market's up and running either up or down. So that's a very useful and unusual, I might add, way of assessing volatility would be the screen flash frequency. Right, so that's that. Then we've got this idea of Bollinger band echoes. Right, on echo, right? So the Bollinger band echo. Now this is something we've developed here at the Forex Super Model, where basically if you imagine the markets are sort of a nice pond, and somebody walks up to the pond and chucks an enormous rock into the pond. Now that is the equivalent of a volatility spike. It creates a big sort of wave and ripples going out through the pond, and what you tend to get if you look at the Bollinger bands, and we suggest that you don't use the default setting. The default is 2 standard deviations, right? So if you look at the Bollinger band thing, there's normally a way of changing the settings on it, and it tends to be set at 2 standard deviations. Now we suggest you change the settings. So you change the settings to 3 or 4 standard deviations. Now we can go into the ins and outs of that, but basically if you change the Bollinger indicator to from the default 2 standard deviations to 3 or 4, you get a clearer picture. And what happens is, and if you put it on say an hour chart, then you'll get sort of this sort of situation. So you've got your Bollinger bands, and then you get this like volatility event which creates this sort of scenario, and this is on 3 or 4 standard deviations. So you've got this volatility event, so the market's been dirging along, and then suddenly whack, the market gets a big kick up the backside from whatever data, doesn't matter. So you get this volatility spike, and that shows up in volatility bands, and as we say, that's standard thinking. But what's not standard thinking is what tends to happen after that is and you can have a look at some previous examples and see what we're talking about. But basically, what tends to happen is you get this sort of situation. Is you get a period of much lower volatility after a volatility spike, and then you tend to get and if it's was an up spike, you tend to start to see these bands sort of dirging up like this in a channel, starting to go up, and then eventually, depending on what's going on, you get a Bollinger echo. So you get, broke the chalk again, not good on that, right? So you get this situation here, and you get this like sort of this echo. So this is the event, if you like, and this is the echo. Now this is important, and from a modelling perspective it is very useful, because when you get a volatility event that creates this sort of shape in the standard deviations, and then you get this dirge period in between, then you know at some stage, and it's not a set time, but it's usually within, I don't know, normally within a week and a half at most. So probably around the 10 day mark at most, you get this like repetition of this event in the form of an echo. So it goes bang, and then you get the dirge, and then you get this echo. Now this echo quite often coincides with support and resistance in the market. So that is a big tell, if you like, on what's going to happen next. So, and the reason, well, there's a lot of technical reasons why you get this echo, but we needn't go into that. I mean, this whole sort of Bollinger Band echo is several videos in itself, but let's not get tied up in it. Basically, what you're looking for is an event, and then you're saying to yourself, well, we're going to get an echo off this at some stage, and you're going to see, you know, it doesn't have to be, it could be the top or it could be the bottom, and there's all sorts of implications in that, and you tend to get this like double barreled echo. So that's something to look out for and think about. So let's just tidy up a few things. Talking about the basic methods of looking at volatility, for example, one of the big flaws of the average true range is in terms of so ATR. So let's suppose you're on the daily on the euro dollar. I mean, I'm just making these figures up, but let's suppose the ATR was 100. So that's 100. Then the market, most people would argue, and this is the ATR of 50. Most people, default traders, would argue that the 100 ATR is more volatile than the 50 ATR. But then that is quite often very misleading because the ATR is just the average true range, so it's the high to the low. So this could be in a nicely gently trending market here, going up or down, and the 50 ATR could be in a mad market that's chopping 50 points every 2 or 3 minutes. So that is the ATR can be very misleading in terms of looking at volatility. So that's just something to bear in mind. So to sum up then, the three default ways of thinking of volatility, moving averages, and one final tip on moving averages, as we're here. If say you're using, I don't know, 20, 50, 100, 200, then if you color code them, say the hottest red, so this is the quickest, and then you might say orange, green and blue. Now we just find this convenient because it's just the way it is. So the slowest moving average, the 200, is the coldest, which we would designate as a blue moving average, and the fastest we would use maybe is 20 and it's red, and then you get this, like, so if you think of it in terms of like flames, and then it gets an orange flame, and then you go green and blue, etc. So when you're looking at moving average, you say you've got the 4 moving averages on your chart, you can very quickly see how the market is moving. So you know, if they're in strict order, so you know, if you've got this and it's red, orange, green and blue, then that's very easy to see. Whereas if they're all muddled up and chopped, that's also very easy to see. So that's just a quick thought anyway. So that may help some of you. Right, now, so to sum up then, the 3 basic ways that most default traders and rank and file traders are taught to view volatility is through moving averages, Bollinger bands, and average true ranges. Now, and we suggest that there are other methods that you can grasp from your screen, which will give you another clue. So what did we start with? we started with this idea of movement, so is versus swing. So look at that, and then we looked at spreads. I mean, we may not have done this quite the same order, but spreads, are the spreads widening or tightening, and how volatile are the spreads actually? How much quickly are they moving? And then you're looking at screen frequency rates, so screen flash frequency measured in hertz or just by the eye. Is it really pumping? And you can view that as like someone shouting in the pit. And in the old days, when you had old school pits where people were shouting at each other, the noise in the pit would literally be an indicator of volatility. When it was quiet, it would be relatively serene and quiet, and when volatility was really kicking off, everybody would be shouting and screaming at each other, so that was a measure of volatility, and you could argue that you can gather that. And interestingly, we can actually measure to a certain degree how hard our devices are working. So assuming if you've got a desktop, and well, for example, when you've got a desktop and it's doing an update, it's making a different noise. Well, when when you're running your trading platform and the market is very active, your computer is actually working harder to keep up with the data, and you actually get a shift in computer noise, which can be measured as well. Now you have to obviously make sure that you're not running any other programs or you don't have an update on the go. But and I know a lot of you are trading from mobile devices, so I'm not even sure whether you can hear a phone change in terms of changing in volatility on a phone, but you certainly can on desktops, and I'm not so sure about tablets and so on. But for us, that's another metric. How hard is the computer working to keep up with the market? So that's the other thing. Then you've got this idea of Bollinger echoes. The Bollinger echoes are a good tell of, you get this event and then you get this secondary echo, which normally coincides with significant support and resistance in the market. So that's something to think about. And then just be aware that a lower ATR doesn't necessarily mean a lower volatility, because it from what we said, it could be chopping madly at 50 or going up gently, trending gently. That was the word I was looking for. Trending gently at 100. So hope you found some of this useful, and look out for the next one in the series. Thank you very much.